Happy New Year, everyone. Chris Lopez here, and we have the December monthly market updates for Denver, Springs, and Pueblo. So we'll be talking kind of basically year over year since we're starting a new year. So this podcast, we have stats, we have about 4 or 5 deals to talk about, and as a pop quiz, one market went up over the year, one market was negative. Stay tuned to find out which was what to pique the interest. So as usual, I got 2 of my co-hosts here, Preston Newberry and Jenny Bayless with Envision Advisors. Welcome back, guys. Happy New Year.
Happy New Year, Chris. Thanks for having us back.
Hey, Chris.
Preston's up here really focused on Denver. Jenny's down with Springs and Pueblo, as many of you know. And our new guest for this series is Bill Rodriguez with Cornerstone Lending. A lot of you have probably known him from some previous podcasts or have probably done a deal with him. He does a lot of our lending down in Southern Colorado and is doing more with our team and our group. Bill, Happy New Year and happy to have you on the podcast.
Happy to be here, man.
All right, so as a note before we go into here, we are in the process of kicking off 2 very big events coming up this year, and they're around house hacking. We have a house hacking webinar series coming up, 6 webinars starting, I think, mid-February. We'll go through core stuff for house hacking, update information. And then end of March, we have a summit coming up for house hacking to come talk about it in person, have it be more experiential, come do networking, come do workshops, come network. And so there's details about very soon, but as a heads up, those are coming out. All right, guys. So we'll jump into the stats for this first part of this podcast. Jenny, what's going on down south?
All right. So I guess I'll be the spoiler now. Colorado Springs was the one that ended the year over year at a negative. So that was kind of surprising to see. I wasn't expecting it to happen this soon. I was kind of thinking it was going to start maybe next month, into the spring, early summer for the year over year being negative. But we ended December at negative 2% for median sales price. So that was kind of interesting to see. And then just in terms of, other stats, I think the best way to kind of summarize it is just, it looks like the market is a little bit of a slowdown, a pause. New listings were significantly down, sales were down, active inventory was down. So it's just everyone was just kind of pressing pause on transactions in December is my opinion on that.
So the negative 2% definitely surprised me.
Yep.
Do you know the average price point for Pueblo on how that performed year over year?
I don't. Their stats are a little lagging, in terms of that. So hopefully we'll get a year roundup on them maybe for next month.
Okay, because I'm curious because I was surprised by the negative 2%, but as you said, all the other indicators kind of supported that story of just what the market, everyone hitting pause, right? Say, I'm out for a little bit.
Yep.
Well, and I think that kind of comes with the lag that we typically see with the Colorado Springs and the Southern Colorado market from what we see in Denver, right? We kind of hit our pause, 5-6 months ago. Springs was still moving along. Obviously things had slowed down, but they didn't get the abrupt, kind of slap your face kind of thing that we had here in Denver. And I think that finally kind of trickled down to the Springs.
Yeah. Yep.
So, to jump forward, Denver was up, 2% year over year, Preston?
2% year over year, yep.
So going back with the analogy, you said, obviously, Springs and Pueblo, and most markets around Colorado, lags Denver. Denver's up, Springs is down.
And listings are up, inventory's up. I think, hopefully we're through the worst of it. I think we're going to have a couple more months here, things still being kind of slow, but as we roll into spring, I think we'll kind of start picking back up again. And I think we're, really optimistic about that.
Okay. So in terms of trends for real estate, Denver's up 2%. Overall, kind of going from a high level, homes were a little bit closer to 0%. Condos over the year were up about 6%. I found that interesting.
I think a lot of that has to do with price points, right? I think, as interest rates got higher and people's borrowing and buying ability got impacted by what they were able to afford, that's when we kind of started to see the change in more condo sales and their prices going up a little bit because we didn't have the activity that we did, in some of the single family stuffs at those price points.
So a couple other stats here, and we're going to share a lot more detailed stats in the show notes. So we're not going to, put you guys to sleep with stats. So check the show notes, email us for all the details. But one thing on the prices I want to talk about here in Denver is that CoreLogic found Denver prices went up about 45% from January 2020 to May 2022. So kind of that, the peak COVID stuff. Prices peaked middle of 2022. Denver prices have dropped 5% since then. Net, we are still up about 40% just before COVID. That was just, that made my jaw drop.
Yeah. I mean, there's a lot to talk about there and kind of unpack. We don't have to necessarily go into all of it, but I think that there's a lot of wealth and equity that's been built through that period of time.
And I think the kind of like taking more to tactical standpoint is it kind of shows that the appreciation party is over. A lot of people say I'm holding on this property or these properties because I'm going to capture appreciation. Great, I get it. Appreciation party is over up and down the Front Range.
Mm-hmm.
I mean, prices I don't think will drop off a cliff. They'll probably be slightly negative like spring, slightly up like ours this year.
I think they'll kind of be flat, a little bit up, a little bit down.
Yeah.
I think it's just going to kind of status quo for a little while.
And so you're saying a lot of the indicators for Denver, I mean, a lot of the current stuff supports that very, flat price increase year over year, just days of markets increased, all that stuff. But you're seeing some very recent indicators just saying overall activity is picking up right now in Denver.
Yeah, for sure. I think, going back to, that time period of COVID, we now have 85% of the mortgages in place are under 5%. So I think that, all these people that have held onto their properties now is going to be the sticking time of trying to get them motivated to sell that. And that's what we're seeing right now is, obviously inventory is coming up, but it's not coming up at, levels that we would expect.
Well, that's the thing. Like our inventory is still incredibly, incredibly low. Like,
total active listings as of 1/1 was 4,750. Our last normal time in 2019, we still had over 5,000 active listings on the market. So yeah, we've seen a 220% increase since December of 21 to December of 22 in listings, but it's still not enough.
Yeah. And also we were just so constrained in inventory and listings a year ago that's why we see those crazy numbers. All right, so check out the website for a lot more detailed stats, but that's the high level. I mean, at this point, price kind of sets the trends in my perspective.
Absolutely.
But this is local. We got Bill with Cornerstone here, Bill the lender with Cornerstone, and obviously rates are national.
Yeah.
Bill, I see you brought your crystal ball. You got some data, some predictions for us.
Yeah.
Tell us what's going on in the mortgage world and some national trends.
Well, I mean, it's really interesting because Fannie and Freddie, they came out with their forecast and they missed the mark entirely. I mean, they basically said in October of last year that rates were going to be at 4.5 by December 2022. Obviously, we missed the boat on that one.
Yeah, we did.
But now, I mean, if you look at where we are in the market and you sort of track, a 40-year history of the bond market, and you look at where we're positioned coming into, I'll put air quotes up, recession because we haven't announced it yet.
Yep.
We're right where we should be. And when I say that, typically when you announce a recession, rates start to fall in lockstep with that. And the Fed's monetary policy has really been trying to pump the brakes on the economy to get things in line so that things can come down. And we just haven't seen the job numbers cooperate with that. But CPI, core price inflation, is going to come out this week. Year over year should be lower. So we're expecting to see rates start to trend January, February downward. Is what
you think that soon they'll start trending downward?
So at the end of the year, so when you start tracking the 10-year treasury and interest rates, typically they're anywhere from 185 basis points to 200 basis points spread apart. And at the end of the year, fourth quarter, we got up to 300 basis points. And then November, December, we started to see about a 200 basis point improvement. We lost a little bit of that in the last weeks of December, mostly because traders go on vacation. Market gets a little bit more volatile, right? And so we lost a little bit of that, but we got some of it back this week. And I think that's in preparation for these lower CPI numbers year over year. So we start to see these signals. We start to get a little bit of relief. I mean, any relief would make a big
Anything
difference.
would help, right?
So I think the new numbers in terms of the talking heads, I'm going to be in a forum this week with the Mortgage Bankers Association, next week with the chief economist from Freddie Mac, getting their insight. So hopefully maybe next month we'll have a better indication on where things are going. But they've backed off a little bit to say the mid 4s, now saying the 5s. But again, anything helps. And I think right now, if you're talking about, the activity that's going on, a lot of people in the conversations that we're having is helping clients manage their payment in the interim. It's very rare in, market cycles like these where you can actually predict where rates are going to go. And we know at some point they're going to come down.
I love it. You're making a prediction.
We know at some point
we just don't know when.
We don't know when.
Yep.
But we can proactively have conversations.
Yeah. What does that mean for buyers right now?
Well, I mean, and I think you guys are probably seeing it too on the street. It's like, a lot of times we're looking at temporary buy downs, we're looking at permanent buy downs, and we're having these different types of conversations about helping our clients manage their payment in the interim. They have a window where if they can stomach the payment and the numbers work and they're still working, then you're going to better your situation in the future. So, whether that's having the seller pay points and fees on the buyer's behalf to have it make sense, or having them take a little bit higher rate, knowing that in the future they're going to refinance and better their strategic position in that property. That's kind of where we're laying it out there.
And are you seeing that a lot of buyers are kind of okay with this and understanding this, or is it taking a lot of education on your side from the lender, to kind of help?
We're dusting some of these. I mean, buy downs. We haven't talked about buy downs in, 8 years, 9 years.
Yeah.
So, because rates have been so low artificially for so long. So, it's bringing people, particularly dusting arms off. I mean, let's talk about the millennial and Gen Y. As you say arm, and they're like, ooh, they freeze up, and it's so you have to educate them, I think, to understand what that means and that there's a fixed rate period. And then you're spending a little time helping them understand. And the listing agent saying, hey, our buyer's qualified and we want to make this house a little bit more affordable.
And I think it's brought back the team aspect of getting a real estate deal done again, right? Because
Absolutely.
You have to get the seller to cooperate. You have to get the buyers educated and understand what they're doing. And the lender's got to be involved.
Yep. And then the listing agent
just throwing
to sell their seller on the whole thing to put it all together.
Absolutely.
In a nice, neat bow, right? And get to the closing table.
I got a question for you, Bill. I know recently Cornerstone bought a bank, converted to a bank. I'm not sure the correct terminology, but now you're a bank.
Colorado Capital. Yeah.
Do you offer ARMs now? Is that part of like the lending?
We do.
Repertoire
We just launched another portfolio arm. It's interesting. We didn't actually realize how much demand there was for ARMs, and we did an offering that we thought was going to last based upon what we had done in our Seattle region. We offered $80 million in ARMs, and it was in 18 hours. We were up to $120 million booked.
So wait, with that, when you say $80 million offer, that means, hey, loan officers
you get
in
to
this region, go
out,
fund the loans.
Go find people where
and
this makes sense.
And it was overfunded in 18 hours?
18 hours.
For what? And crazy.
Wow.
What kind of arm was it? Can you tell us a little bit about
5.6.
Okay.
5.6 arm. Yeah. We had a 5.6
And
arm.
this was
and
the
it
last
was
month
in
or
the
two?
mid fives. That's what made it super hot.
Yep.
And at the time they rolled it out, I think it was early November. Maybe it was late October.
So like what, a 2-point spread for investors?
Oh my, yeah. Well, that was only owner occupied.
Okay, yeah.
So, and that was even what was crazier. So that was people who were either under contract or they had a new build closing in proximity, right? And gone.
Wow.
That's impressive.
Yeah.
So the way the Cornerstone Bank looks at it is, hey, we got this allotment. Let's go fund it and then figure out another offering or portfolio position.
So portfolio in a bank, it means that, banks have to bring in deposits in order to lend money. So we can lend a certain percentage of what we have on deposit. Because we're a virtual bank and our rates of return are higher, we're actually bringing in deposits. I don't know if it's still at this number, but about 40 million a week from other banks who are placing their money with us because our rates of return are higher. So as soon as we stack up some more cash, then we roll out another.
Okay. That
makes sense.
That connected a few dots for me.
Yeah.
Thank you.
Yeah.
So I want to kind of shift over to a handful of deals because we covered some trends. Again, if you want more details in the show notes or reach out to us, we got a bunch of details on stats, but you guys got the important stuff. We got a handful of deals here that we're going to walk through from a very high level to show that what type of deals are making sense and that deals are still happening in the marketplace. In no particular order, I know you and I caught up yesterday, Bill. You and Jenny, or maybe you and Leah.
Yeah, it's me and Leah.
Okay, so you closed the loan. Leah closed the property. It was a house hack in Woodland Park, which is outside Colorado Springs. Give us the rough numbers on there of the property and just the house hacker situation, because that was a house hacker, right?
Yeah, he was 4 bedrooms, and he was at 6 5/8. 2866 was the principal and interest, taxes, insurance, and he is living there for $366 a month on the rent by room strategy.
All right, so even at kind of like probably the upper end of being at the top of the mortgage rates is what we think.
Right.
6 5/8. Bought a house hack. This was December?
He
November?
closed October 31st or 1st of November, somewhere in there.
So early November he closed. Bought the property. Numbers still make sense. He's living for $300 and change a month.
Yeah.
Okay. And is his intent then to refi at some point, or do you know, or just
well, we
depends?
just had his consultation actually yesterday or Sunday, and we talked about with his situation, he needs to file returns. So we're sort of reviewing that with him and making sure that we're creating some more cash flow around the businesses that he has.
And just to intervene, so he's self-employed. So let's talk about this, because this was a very great point for self-employed people. Keep in mind as tax season is unfortunately here. Talk about, because self-employment and loans is kind of like oil and water many times.
Can be.
Don't always mix well together. But
your CPA's there to help you take advantage of the code, and we're trying to squeeze every cent out of a paycheck or your P&L and balance sheet. So by nature, the two financial service professionals are kind of in opposition, but we, work with folks on the front end, particularly right around now, to be proactive and find out what it is that they're trying to accomplish this year.
Yeah.
And then work with their financial professionals to say, okay,
here's what we're trying to achieve over here. Can you help us make that happen? Right.
And can we, is some of this, are we able to push it off, or what are the tax codes? We're not experts in that area, but we work with them to understand what we can do and what makes sense. And they are, showing the adequate amount of income that they need without paying too much in taxes. That's the balance we're trying to strike.
Yeah, and that's something I think it's very important to highlight, since many of our listeners and investors are self-employed.
Yep.
As investors, or a lot of real estate agents are in the same boat as well. This time to talk to you or their lender they work with to figure things out. Whether you're buying Q1 or Q4 this year, your tax returns are going to impact you anytime in 2023 and probably 2024 as well.
Yep.
Because as Bill said, on the tax side, hey, write off as much as possible, save taxes, but the flip side there is, you want a loan, they say, oh, well, you reported X amount of dollars on your tax returns. You don't qualify for a loan. And so there's that balance, or,
your lifestyle
that game to play.
says 150K, but your tax return says 20. So,
there's something in the middle here.
Yeah, that's right.
So keep that in mind when we're out there, because if you are self-employed, meaning a non-W-2, or you might be making a W-2 to self-employed transition this year, talk with Bill, talk with your lender, talk with your CPA, because you want to have that conversation now before we file the taxes.
Mhm.
I do it every year. And the first couple of years, I did not execute well, and it bit me in the ass. And now I've learned, hey, I'm not going to do that anymore. Let me talk with my team, my lender, my CPA, to figure out how do I want to pull and push these levers.
Absolutely.
So obviously do that. We'll make sure Bill's contact details are in there, because self-employment is kind of one of the niches you've carved out, for lack of better words.
Yeah. And we'll do it with under 2 years. We're one of the only.
Well, you have some creative stuff too.
Yeah.
Or creative, I mean, you got some ways to really help, like, that I've seen from a lot of lenders I've talked with. You have a lot more products and experience with self-employed people than the average lender out there.
Yeah, for sure.
Is that a fair way to say it?
Yeah, absolutely. Mm-hmm.
All right. So house hacking still works. A few weeks ago, we also did a house hacking webinar with Jeff White and Ben Einspar, more Denver focused.
Mhm.
Same thing. Numbers are working. So don't get too scared of that if you're house hacking. Now, we know a lot of our investors are not house hacking. And Jenny, you had mentioned right before this podcast, I think you said your words were 2 minutes before I got this podcast, Leah got something under contract in Pueblo. What was that?
Yeah, so she got a BRRRR deal under contract. So I kind of think that this year is, kind of year of the BRRRR, year of Pueblo. I think it has a lot going for it. Of course, I think that the environment is making BRRRR a little bit more difficult back from, I guess, maybe when I had it easier when I was doing the BRRRR strategy, because you have this, volatile interest rates. You have absolutely no idea really what your takeout finance is going to be. So that's one thing to be, weary of and mindful of. And I think also kind of appraisal values, since, we're seeing kind of the prices fluctuate too. We don't know what your, ARV is going to come out at. You might think it's X, but it might be Y, 180 days from now. So just, kind of keep that in mind as you're underwriting your properties. But yeah, she got her client a mid 100s, and she believes that the ARV is going to be in the low 3s, high 2s, on the safe end of things. And it's zoned, and it has some outbuildings that will allow for a duplex situation. So I'm really excited to see how this one plays out. I think it's going to be a home run, assuming that they're able to manage their costs pretty well. So,
and it sounds like this property has a couple of factors, like, hey, there's the BRRRR potential, but there's some upside or value add based on the other structures on there for making an AD or duplex, right?
Exactly.
So
like Leah went. Yeah, she went into it thinking like that they would change the main building into a duplex because it would be appropriate for that. But I also told her to explore changing the outbuilding into the second unit, depending on the utility situation, just because it was there, and that might be able to kind of raise the return all around on that. So I'm very curious to see what the clients end up doing. They have different options, different exit strategies too. So that's important. If everything kind of goes south on that, which I don't think it will, but it's just important to bake that in.
Yeah, that's one of the, the opportunity shifted to where, BRRRRs are more high potential here in Colorado. But the takeout financing, like, that's been like the wild card.
That's the wild card. Yep.
But we got Bill's crystal ball here, along with another crystal ball. Say, if rates drop, if you're up for some interest rate risk, that could like time some things really, really well.
That could make for a really nice property.
Do you know, Jenny? Are they doing the takedown financing, hard money, HELOC, cash, some other?
Yeah.
structure?
So I was furiously texting Leah prior to going live. They're doing a construction loan.
Oh, cool.
With a community bank. Yeah.
Okay.
So
will they lock the rate for their takeout financing with the construction loan?
I don't know. I need to ask her what they're doing. I think they're going to try to go conventional, but there's probably some things with the house that it won't appraise for at this point. So I think they might have to go the conventional loan, but I don't know how they're going to do their takeout financing on that. But
Preston, what are the construction rate interest rates right now? I know you you play in that space?
I haven't looked since the first of the year, but it's still going to be somewhere around 7.5-ish.
Do you guys do construction loans, Bill?
Yeah, we do.
Yeah.
We're rolling out our construction product.
Okay.
Yeah.
And we're going to have a 1-time and 2-time close.
Okay.
Yeah.
So construction loan, do you guys also do like bridge financing or kind of like hard money-esque financing for these types of deals? Or
We do bridge.
Okay.
We don't do the hard money. But yeah, we'll do bridge financing. We're rolling out a HELOC. We're rolling out all those products.
Cool. And that can also probably be more seamless to wrap into takeout financing, more permanent stuff.
Mhm.
All right.
Package it all up into one little thing.
Yeah, no, I'm really curious now. I mean,
gonna
since
be
you guys
great.
converted
It's
to the
been-
bank, like
Yeah.
I know the details. I'm really curious to hear about.
Yeah, they roll
The
out.
product
It
lines, how they
takes a
work.
while. We bought a really small bank in rural Texas. So, and we're a 19, $20 billion mortgage bank. So it's taken some time to get their systems able to handle the volume that we're bringing, but we're getting there.
Yeah. Good growing pains to
Yeah,
have. Sounds
absolutely.
like.
Yeah.
All right, so moving on to some other deals here. Preston, you mentioned earlier a very unique and high-end house hack here in Denver Metro.
Yeah.
That we have in our contract. What's the...
One of our agents worked with one of our clients to get under contract on like over $1.5 million new build with a separate ADU in the backyard in Denver, which one I was really surprised to see somebody actually was able to get one completed and built in Denver.
Was it Highland?
No, it's like North Highlands.
Okay.
Yeah. But brand new build. Main house is 3-bed, 1-bath, and then the ADU is actually over the garage. So they have an oversized garage with an ADU, all high-end finishes, 1-bed, 1-bath up there. And I had a chance to go walk that the other day, and I was really impressed.
And they're
So-
doing like a high-end house hack in here, right?
Yeah, I think they're gonna do possibly short-term rental with ADU, and kind of see how that goes. But yeah, I was just really impressed to see somebody actually got one built, and they did a really good job with the high-end finishes and like made it a nice place.
Yeah, one of a couple dozen ADUs built this year in Denver.
Right.
I mean, but that's cool to see, and that's one of like a much more niche type investment product, the high end house hack. But we do quite a few of those every year, and it's really interesting because it's you hit this point as prices go up where rents don't make any sense. And you hit this like I guess the luxury or premium market and the house hack, and especially when you get to like the short term, medium term rentals. The income all of a sudden just like exponentially jumps up, and there's a very
especially with
interesting break point.
location, right?
Yeah.
I mean, those are so location based. They want to be close to the hot spots in town, and I think there's some really good opportunity there for that. So I was just excited to see somebody actually going in on a high end luxury house hack. So
And so I assume that must be like a jumbo loan takedown. It has to be.
yeah, it would have to be.
Yeah. Okay. Do you guys do jumbo loans too?
Of course.
Okay. Cool. I'm learning.
But
That's
of
right.
course.
Yeah, I love it. All right. So high end house hack. And this is more just a general trend. I can't, we won't go into specific deals, but I mean, we have a bunch of clients, a lot here in Denver that are in the various stages of doing basically like a fix and list, which is where we talked about this a lot during the PAM 2.0 series, where a lot of people, bought rentals 4, 5, 6, 7, 8 years ago, have ridden the amazing appreciation wave, but now they've got a 3 to 3.5 cap property, $500,000 plus in equity. So not a great rental now, but they're in the process of, running the numbers and starting to like figure out the tenant exit strategy, figure out the updates, and getting in line to list for this spring or list for next spring to kind of time the market. But we have a lot of clients like gearing up for that. Some are doing 1031 exchanges. Some are just taking the money off the table and investing in other assets or stocks or other markets. But that's actually a very interesting trend that's picked up a lot. And that just kind of comes down to numbers and trends.
I think it has a lot to do with the market situation right now, right? I mean, for the last 2.5 years, you could put anything on the market and it would sell. And now, cool, you got to have a little bit of a different perspective. Like, hey, I want to sell this property. I know the market's changed. What do I need to do to get my highest and best dollar out of it, and what makes the most sense? And I think we're going to see that continue for a while.
And with moving on with the deals notes here, some I'll say fun. 3 months ago we picked up, or we kind of reinvigorated our deals email list, and so we got that going out there. If anyone wants to go out there and join that email list, it's in the show notes, or email us. What we do is once a week we're sending out an email with 2, 3, 4 properties, some off market, Some
are
with
on the
investors
MLS.
that are pre-listing, some MLS where you just see unique deals and deals that we like. Check it out. We've actually put together already a couple deals off of that. Lots of interest. So if you want to look at something, happy to get you on that list. And also something that's popped up as well. A lot of agents and investors have reached out to us to see if we can help market their properties through that channel. We're happy to, of course, because we have the distribution there. Reach out as well. But like Jenny talked about this being maybe the year of some, BRRRR deals coming back in fashion. I also agree with just more about actually having deal flow will come back in fashion this year.
Mm-hmm.
And so we're putting a lot of energy into that. So make sure you join our deals list and participate. A couple other trends here, and this is something that Bill and Jenny and I started talking about 2 or 3 months ago, and I found fascinating. But Bill, you're doing what's called some forward commitments, I believe, right? With some builders. Talk about that.
That's kind of our secret sauce. So, Cornerstone has come up with sort of a proprietary blend of being able to work with builders. The biggest problem with these builders is they have a bunch of inventory coming out of the ground. They got stalled out because of interest rates, because they were priced wherever they were priced. And, now they're $400 to $900 more a month. And it's just the buying pool is cooled off.
Yep.
But they're sitting there built with all these carry costs.
Which are not cheap.
Yeah, inability to sell, right? So what we're doing is we're having these builders pay upfront to buy down the rate and offering the ability to market for a period of time, 90, 120 days on average, interest rates that are significantly below market, like in the fours, mid to low fours. So there's some opportunities, I think, out there right now in where we would love to be able to get those out to your guys' stuff, because we have stuff locally here in Denver. We have stuff up north. We have stuff down south that.
Can you send us the list for those projects so we can keep it on hand for?
And,
okay,
yeah,
for sure.
And they've been so successful that all of our builders are moving towards this. In fact, we're getting inbound calls now where builders we haven't even worked with that are just like, hey, I heard you guys have this platform that allows us to do it. And it's really, really unique opportunity to get something that is like a unicorn. It doesn't exist anywhere else in the market.
Yep.
So
it's
pretty cool.
I definitely, we started talking about that. I think it's a really cool opportunity in the marketplace right now. So I got 2 questions on the new build communities.
Yeah.
How does that, because those are owner occupant rates, I believe.
Correct. Yeah.
And, so most of our owner occupants are house hackers.
Yeah.
So it worked for them. Are there any type of those forward commitments for investors coming into new builds? Or how's that work?
Well, so we haven't been able to quite figure that out yet, because you're running into, we may be able to do it for a pool for investors. It just depends on the product. We have it, and it depends on the builder. I would certainly say some of the stuff that we have in Pueblo, because it's lower end townhomes attached, and they build them 4 at a time attached, that they could buy a block, and we would consider that. But a lot of it's really for owner occupied only. The biggest issue that you run into is the caps, because every loan type has a specific max contribution that all interested parties can make to the buyer in helping them cover costs. And investors are just capped at 2%.
Yep.
And so that's what makes it really, really difficult, because, Fannie and Freddie, with all of their loan level adjustments, they're pricing that cost up front inside the loan. So that's why those investor loans you have to pay more. There's no par rate right now.
So in one of these half a dozen new builds where you have the forward commitment with, Preston takes a house hacker there. They can get, rates in the 4s, low 5s, type range.
Yeah.
Jennings takes an investor client there. Is there any benefit, or are they just getting the par interest rate for investment loans at that same complex?
Again, it depends on certainly we would look at something in Pueblo versus the stuff that we're doing. TrueMark's one of our builders, and they're in Windsor. They have the beautiful property, beautiful semi-custom stuff. That's $750.
I've heard really good things about them.
To $1.5 million on acreage, and beautiful stuff. That probably is not going to be ideal, right? But like there's also Hartford Homes, which is another one of our builders. They have condos, 1,200 square foot condos that are awesome, priced at $370 to $380.
How many bedrooms?
2.5. So one of them's like a office. Yeah. Cool stuff, beautiful stuff. Where that could work. But yeah, I mean, if you're looking at it, I would say they'll probably do a 2% contribution towards cost or something like that for an investor to help buy down that rate.
Which is what they're maxed out at anyway.
Right, it's what they're maxed out at.
So get something, but not quite
we would do whatever we can.
Yeah, of course.
Yeah.
So kind of second part of this question, and Preston, Jenny, we've talked about a lot this on the podcast last year, where when the market, was super tight and, buyers were just competing with each other, the vast majority of builders and new development projects just said no to investors. I believe that tune has changed. I mean, I'm on some list. You guys are a lot more plugged than I am. What's the update on there with developers?
The update from that is bring us any offers you can.
So
we need
open
to
arms?
sell our houses.
Oh, yeah.
Yes.
All right.
They've changed their team.
Yeah, big time.
So just the whole industry, just, hey, cool, we're open to everyone
Yeah, I mean,
now.
I don't know specifically from builder to builder, but I just know they're marketing anything and everything they can. And the builders I have talked to are like, oh, yeah, no, we'll take investors. Like, not a problem. So are you seeing the same thing?
Same with, yeah, same. And then also some of the developments that, we've had clients buy in, they're limited per person. And that's thrown out the window now too.
Cool.
Yep.
Well, that's good, especially for a lot of people who are selling properties. That might be a good 1031 upleg option because
there's a lot of inventory sitting around.
Yeah,
right
the new inventory. A lot of investors are like, hey, I want to go a little easier, and and I fall in this camp now too. Is I'm gravitating much more towards newer stuff personally, just for ease of stuff, even if it's a lower return. But I like that play too. Is where hey, if builders are taking that, there's some trade up options there.
Absolutely.
All right. So let's see. We talked self-employment taxes. We got some questions here. Oh, one trend I'm curious, Bill, for you, because for the last couple of years, we had a lot of house hackers. This is very nuanced. A lot of house hackers doing some like prepaying PMI for mortgage insurance.
Yeah.
As rates have jumped up, have you seen a difference in people prepaying PMI? Is it the same, less, or more?
It's on a deal by deal. So I've got one right now where this guy is relocating from Fort Morgan. He got a job in Longmont and he wants to live close enough to commute. And he's pushing his qualifying power because he works at Smucker's, right? And Smucker's is a great job, but it's on that lower pay scale. And so he's stretching stuff a little bit. And I think it really depends on who pays it, right? If you can get the seller to pay that on your behalf, great. But, and the reason I say that is because if you're looking to prepay and not have the seller do it, in my opinion, then you might be throwing some good money after bad because you're going to refinance anyway.
That's what I did on my deal when I closed on my new primary back in October. I was kind of sitting down looking at all the options and looking at it. And it was like, cool, mortgage insurance is going to be $180 a month or whatever, or it's going to cost me $12,000 to pay it up front. I know I'm going to refinance this property, or at least 99% sure, right? Unless the world changes its tune again. But to me, it didn't make any sense. There was no net gain there for me to prepay the mortgage insurance. I'll just pay it every month for a year or year and a half, refinance, and I'm money ahead,
less.
right?
Yeah,
so
the cost is so much less. So it depends on who pays it.
Yeah. Well, even I was thinking, because, for years, I was a big fan of prepaying PMI for numerous reasons. Now with, hey, if rates are going to drop in, 6 months to 18 months, refinance, that's not a good use of money, generally speaking. Now, some situations, like I say, if that makes the qualifying difference, absolutely, get the deal done.
Yeah, and he's stretching to the top end. But in those cases, we're asking the seller to cover that for us as a concession, and it's 2% to the seller makes his numbers work. The seller gets the traffic that they weren't getting before, and everybody wins.
So in those deals, it sounds like you're just saying, hey, to make all the numbers work and kind of find that sweet spot between underwriting, payment, what we can do in terms
GTI,
of all that. You're like,
Mhm.
hey, this 2%, 3%, hey, we're going to put the PMI. Hey, this will do a rate buy down. This will do a 2-1. You're taking out the scalpel and just really getting detailed on there.
Customizing, you got to.
Yeah.
Man. I mean, it's one of those things where it's like, whatever. Let's make a deal, whatever it takes, whatever it takes.
I feel like you got some game show host coming out there in you, Bill. We might do a new series with you here.
Wait, there's more.
That's right.
Cool. Well, I'm going through my checklist here, guys. I hit on the topics and questions I wanted to, but I want to end up with a roundtable. Bill, Preston, Jenny, any final thoughts, questions, debate topics you want to throw out to the panel here?
I mean, I just want to say, and we've talked about it a lot, there's still a lot of opportunity out there. Again, don't get freaked out by the interest rate side of things. There's plenty of options and ways to work around that.
Mhm.
And I think that we're, starting to see, people really understand that, and they've got a good team around them. And that's what it takes right now. You got to have the right people in the right place to get a deal done. And I think that there's going to be a lot of stuff coming up here in the spring.
Yeah,
Well said.
strategy makes the difference right now. Strategy makes a difference.
Jenny?
Yeah, I'm kind of excited to see the potential deals that the fun stuff that you have to, be creative on and see what you can squeeze out of a property are going to come up because like I mentioned, we're seeing more and more people do BRRRRs in Pueblo. I'm seeing some really cool wholesale deals come out. So it kind of gets me excited. It's like, back when a few years ago when we were doing the creative stuff. So
Yeah, deal making for 2023. Awesome. Well, guys, thank you so much. Another fun podcast. Happy to kick off 2023 doing the podcast with everyone. Enjoy it. This was a solid one. All the numbers in the show notes. If you guys want to get to our deals list, email out to us. Great tip. Talk to Bill or your lender and your CPA if you're self-employed to figure out the tax lending game. If you guys have any questions on strategy, deals, reach out to us. We love talking real estate and here to help you out. So thanks, everyone, and Happy New Year.
Thanks, Chris. Happy New Year.
Thank you.
thanks, everyone.